Good morning and good afternoon. Welcome. Thank you for joining the ETS webinar series. Today, we're going to be talking about unlocking possibilities and harnessing the power of tax credits and incentives for business growth and gain. My name is Scott Willis. I'm with Engineered Tax Services. I appreciate you joining today. Appreciate our team being here to support us too on the technical side. We will be going through the presentation. It should take around 30 to 40 minutes. And if you will put any questions you have in the chat, we'll try to address those at the end of the session and address as many of those as we can, answer any questions, and welcome any feedback that you have. And my name is, again, Scott Willis. I've been with Engineered Tax Services about 8 years now. We work with CPA firms all over the country. We help real estate investors to identify engineering-based programs that will improve their bottom line. We partner with owners to strengthen their investments and increase their ROI using all the tools in the IRS tax toolbox. And Engineered Tax Services has been in the business of providing these services for about 22, 23 years now. It was founded on the basis that a lot of the tax programs weren't really available to the general public, smaller investors, mid-sized companies. And the idea was to make these programs accessible to others and introduce them to all of the different tools that are available within the IRS guidelines for improving performance of assets. And we're in, of course, the time of year where the tax season has just ended for our extension filing period. That doesn't mean we're not already beginning to ramp up again for next April when we file again. And of course, preparing for our end of year tax preparation and getting everything in order for that. So now is a perfect time to go into a little more detail about what programs are available for folks and how we can help to manage those and get the best benefit for our clients. And so today we'll be talking about several different areas of tax strategy and some stimulus plan updates for the 2023-2024 year. Obviously, we just finished the 2022 extensions and getting ready for 2023 tax year. And then we'll have some other information on 2024 changes that may be coming down the road. And we'll focus on a few areas. Primarily, we want to talk about cost segregation and bonus depreciation and what that means based on the year an asset was placed into service. We'll talk about CapEx improvements and disposition of assets and credits that can be utilized there. We'll talk a little bit about energy tax credits and incentives and what's available for use in those areas in terms of looking at the energy efficiency of buildings, whether it be improvements or new construction. And then we'll go a little bit into research and development tax credits, employee retention tax credits, and what's available there. Other areas we will touch on are purchase valuation studies, 5G wireless revenue opportunities, and bonus next level tax exchange strategies that are available too, including opportunity zones, historic tax credits, solar renewable energy tax credit investing, and so on. So let's get started. Pro tip number one is understanding the real estate tax laws and how they apply and how they will be changing throughout the year. So we keep up with that at ETS and make sure that we have the latest and greatest information to assist with the utilization of all of these programs, including cost segregation and bonus depreciation. So what is cost seg? Cost seg is a detailed engineering study of a property that helps to identify and reclassify the assets within it. So normally, a real property, buildings are depreciated over 27 and a half years or 39 years, depending on if it's a multifamily type property or a general commercial property, which would be 39 years. And under tax code, personal property can be depreciated on an accelerated basis, so over 5 or 15 years. And in addition, we now have bonus depreciation, which is applicable. So the IRS allows this. It's in section 1245 of the tax code. And essentially, we're applying this in order to take advantage of what's been written into the tax code over the years. And it started, the accelerated depreciation program started in the mid 80s. And it's since been expanded, usually through court cases and things like that, which help define what is applicable. Our process involves going on site to the properties and conducting a detailed review, including photographs and notes that are then taken and applied to an engineering-based study. We also use documents that are available on the property, such as the appraisal. If it's a new construction property, we'll use the payout that the contractor provides that differentiates all the areas of the building cost. Blueprints, spreadsheets, etc. are also applied. And through that, we're able to develop a detailed engineering study and allocating all of the costs to the different components of the building. In addition to that, if improvements are being made to a property, even after it's purchased, we can capture that and the disposition of those assets. And I'll go into a little more detail on that in just a minute as well. We can also look back. So this isn't just for properties that were purchased in the current tax year, but anywhere generally 5, 10, or even further back, we can look at the possibility of conducting a cost seg study and capturing some of that additional depreciation that can be applied in the current tax year. And the process for that is just simply filing a 3115, which is a change in tax process, and we will fill that out for our customers, or their CPAs may do that as well. In the past year, there have been new depreciation rules applied over the past several years, in which 100% bonus depreciation can be taken. That has changed and is changing as we speak year by year. So for the past, I think it started in 2016, you could take the bonus depreciation, meaning all of the components of the building that we accelerate could be taken in the current tax year. So essentially turbocharging the process of accelerated depreciation. This year, the bonus depreciation has been reduced to 80%, and it's being slowly phased out. So next year will be 60%, and so on. It's still an excellent benefit to take advantage of, even when the bonus depreciation goes away. The process of cost segregation is still very beneficial because you're taking a significant portion of the asset basis and applying it in the first few years of depreciation. It does apply to the purchase of existing buildings in addition to new construction, renovations, and improvements. And again, for 2023, it's 80% bonus depreciation and 60% next year. So if there are properties that have been placed in service this year or in recent years, it's best to go ahead and take advantage of that now in order to apply the bonus depreciation. In addition to that, on the energy side, Section 179D and 45L expanded to expense immediately up to $1 million, including roofs, HVAC systems, security systems, etc. And I will talk in a little more detail about that shortly. To give another illustration of the accelerated depreciation process, on any property, assuming again a 39-year property, you're depreciating over the life of that asset, and accelerated depreciation allows you to front load a significant portion of that, which gives you additional write-offs that can be applied to improve the bottom line, particularly in the first few years of owning the asset. So that's the advantage of it. Over the time of holding the property, the same amount is paid, but by utilizing that up front, you're able to take advantage of the time value of money. Going into a little more detail on the improvements and renovations and how those can be taken advantage of. When a property is purchased, we would typically do a purchase study to capture the cost segregation elements. And if improvements are made, what we're able to do is identify the components of the building that have been removed and capture that cost as an immediate write-off. This is very helpful in terms of keeping the, again, the value that's been removed and not continuing to depreciate that, but writing it off immediately because those components are no longer part of the building. So by capturing that in our initial study, we can then write that off. In addition, the improvements that have been made can be cost segregated, and we can identify those components that we can continue to accelerate depreciation on. So it's a very powerful tool to take advantage of and remember. The important thing here to remember also is that the improvement study should be conducted in the year in which those improvements are made. So once those components of the building have been removed, they need to be written off that year. That's not something that can be captured later and going back, looking back on. Whereas the initial purchase study can look back over previous years for assets that are already in service. So those dispositions is capturing those values of removed components. Could be anything in terms of the building construction, lights, air conditioning, windows, flooring, etc., and writing that off immediately, even if it has remaining life on it. Since it's being taken out of the building, there's no reason to continue to depreciate it. This is called PAD, or partial asset distribution. We maximize these improvements with the study, capturing the abandonment of those components, and again, improving the ROI. Pro tip number 3, we want to capture the energy tax incentives and credits that are available to us on any level, whether it be federal, state, local. And those also can be applied retroactively in some cases. So we will be able to look back and see if there are any additional benefits by meeting the current energy efficiency standards in these areas. So there are 2 areas of it. 179D is for energy efficient green buildings that are 4+ stories, whether it be new construction or renovations. Most new construction is going to meet the standard for the energy certifications. So this is a matter of simply capturing that and certifying it, which we're able to do. This applies to commercial, retail, industrial properties of all types, residential or multifamily, again, if it's 4 stories or higher. And up through 2022, it was up to $1.80 per square foot bonus tax deduction. That is actually changed in 2023 and going forward, and there are new rules in place which we can help with. And there are additional parts of the certification that are required, including meeting the prevailing wage in the local area, which again typically will apply as most contractors, subcontractors are compliant with that. So we are just making sure and certifying that for the results. And this applies to the $1.80 per square foot does apply to anything between 2006 and 2022, and the new rules will apply 2023 and forward. 45L is very similar in terms of certifying for the green energy standards in multiple areas, including the building envelope, HVAC, and lighting. This applies to residential and multifamily 3 stories or less, and it's a per unit tax credit. It's also gone up as of 2023 or was 2000 through 2022 and applies to those areas. So these are very powerful tools that can help in terms of taking full advantage of the energy and cost segregation tax savings that are available and making the financial performance of the asset that much stronger. So let's talk about some of the advanced tax strategies that are available. We have R&D tax credits, employee retention tax credits, 1031 exchange, solar, historic tax credits, opportunity zones, and grants. These are several of the areas where we have expertise at Engineered Tax Services and can help you determine what is available in your particular situation. This is one of my favorite quotes. If you get confused, listen to the music play by Grateful Dead. That's not the Grateful Dead in the picture, that's Willie Nelson. But these are, I don't know if they help us with our tax strategies or not, but it certainly makes sure that we know how to apply any types of benefits that are available to us for the future. And with that, I want to thank you. Here's my contact information. I want to see if we have any questions that we can address at the time. See, thank you, Daniel, for all of your assistance with the information that we can access through our website. Okay, we have one question for residential properties. How long do you usually have to hold the property to avoid depreciation recapture? There is no set guidelines on that. There will always be some depreciation recapture potentially, but there are ways to mitigate that, including 1031 exchange, which is available, and we will try to reduce that as much as possible by making sure that that those programs are applied as well. Okay, well, thanks again to everyone. Let's see. Okay, another for solar. Do you look into state and federal credits? Yes, we look at state, local, federal, all of the available potential credits depending on what region or what state the property is in to see what can be taken advantage of. And we're happy to help with that. Okay. If there are no other questions, again, appreciate your time. Please feel free to reach out to me. And if there are any additional questions, I can help at that time. Or if there are any potential projects we can look at for you, we're happy to help with that too. Thanks again.